All right, let's get right into it. Today, we are breaking down a topic that's absolutely crucial for your safe exam: RESPA disclosures.
You know that feeling, right? You apply for a mortgage, and then, bam, you're buried under a mountain of paperwork. It feels like an avalanche, but believe it or not, every single one of those pages has a very important reason for being there.
Yeah, this isn't just busy work somebody made up, it's the law. And it's all about protecting consumers. Honestly, learning these rules isn't just about passing a test, it's about laying the foundation for your entire career.
So, at its heart, RESPA, the Real Estate Settlement Procedures Act, is all about clarity and fairness. Think of it as pulling back the curtain on the whole settlement process. The goal is to make sure borrowers understand exactly what they're signing up for and to shut down any kind of shady backroom deals. So, here's our game plan. We're going to follow the natural journey of a loan, hitting every key disclosure you have to know for the exam, from the first application all the way to what happens after closing.
Okay, let's start with the basics. Before we get lost in all the specific documents, we need to ask, what kinds of loans does RESPA even apply to? RESPA is going to cover most of the residential loans you'll ever come across. We're talking about properties someone is actually living in, owner-occupied, from a single-family home up to a fourplex. And for the exam, remember what it doesn't cover. Things like commercial buildings, giant farms, or temporary loans like bridge loans. Those are outside RESPA's world.
The best way to get a handle on all these disclosures is to follow this timeline. Think of it like a roadmap for the loan process. Each stop has its own specific trigger, and knowing when these disclosures are due is just as important as knowing what they are. And that brings us to our first stop, the application. The moment you have a complete application in your hands, a clock starts ticking. 3. Burn that number into your brain. You have exactly 3 business days from a complete application to get the borrower their initial disclosures. That is a hard deadline, and it's a classic exam question. So what are these first 3 responsibilities? First up is the Home Loan Toolkit. It's like a how-to guide for the borrower. But remember, it's only for purchase deals. Second, the Mortgage Servicing Disclosure. This basically answers the question, who am I going to be sending my payments to? And third, you give them a list of at least 10 local HUD-approved counseling agencies. It's all about empowering the borrower with information right from day one. Okay, next up on our loan journey, the borrower has to start shopping for services. Think title insurance, appraisals, things like that. Now, what if you want to refer them to a company that you happen to have a financial stake in? Well, RESPA has some very, very strict rules about that.
This is a huge test topic, so listen up. It's called an affiliated business arrangement, or ABA, and the threshold for this is incredibly low. If you have an ownership interest of just 1% or more in that company you're referring, you're officially in an ABA. So, can you still make that referral? Yes, absolutely. But, and this is a massive but for your exam, you must provide a formal written disclosure. This isn't just a casual heads up, it's a required step, and the timing is crucial. It has to happen at or before the moment you make the referral. This disclosure really gets to the core of what RESPA is all about: consumer choice. You have to be totally transparent about your business relationship, you have to give an estimate of the cost, and here's the most important part. You have to make it crystal clear that the borrower is not required to use your affiliated business. They are always, always free to shop around. Okay, we are getting so close to the finish line. The closing table. At this point, RESPA's focus pivots to the escrow account. You know, that special bucket of money that's set aside for future taxes and insurance payments?
This is such a critical document. It's called the Initial Escrow Statement, and it itemizes every estimated payment for taxes, insurance, and anything else that's going to be paid out of that account for the first 12 months. It's basically a forecast, so there are no nasty surprises when those big bills come due.
So the loan is closed, everyone's happy, but the relationship doesn't just end there. If the servicing of that loan gets transferred to a new company down the road, RESPA steps back in to make sure the communication is clear and timely. You really have to pay attention to the timing here. The current servicer sends a goodbye letter at least 15 days before the transfer happens. Then the new servicer sends a hello letter within 15 days after the transfer. But the real key, the thing you'll almost certainly see on the exam, is the 60-day grace period. For 2 months, if a borrower messes up and sends their payment to the old company, they can't be hit with a late fee or a negative mark on their credit. It's a fantastic consumer protection. Okay, let's pull all this together. This is your screenshot and save moment. These are the critical facts you absolutely need to have memorized cold for the safe exam.
Here it is, your RESPA disclosure cheat sheet. It summarizes the core disclosures, their timing, and the one key detail you need to remember for each. Seriously, if you know these 5 items, what they are, when they're due, and why they matter, you're going to pick up a ton of points on the test.
And we have to talk about RESPA Section 8. This is the heart of the law's anti-corruption rules, and it's actually pretty simple when you break it down. You can't get paid for just a referral. You can only get paid a reasonable, fair market value for services you actually perform. Anything else, kickbacks, splitting unearned fees, it's all illegal, and the penalties are severe.
Ultimately, every single rule we've talked about today comes right back to this core principle. Every disclosure, every deadline, it's all about giving the consumer the information and the freedom to make an informed choice and making sure the whole process is fair for everybody involved.
Look, mastering these rules isn't just about passing a test, it's about your reputation. It's the foundation for becoming a trustworthy, professional mortgage loan originator from day one. This is how you build a career you can be proud of. Now go pass that exam.